Welcome you to this panel on India. I'm Annabel Brodie-Smith. I'm the Communications Director of the Association of Investment Companies. I have been there for nearly 27 years for my sins. And I'm very excited to be moderating this panel on India. It's a sector that's been performing just so well. You know, if you look at the average trust in the Indian subcontinent sector on the AIC website, it's up 23% over the last year, up 58% over 5 years, and up 146% over 10 years. And we've got a lot to talk about in this session. We've had an election in India this year. We've had some interesting repercussions from that election. And, you know, it's such an exciting and dynamic area. So I'm really excited to introduce our managers today. We've got Ayush Abhijeet, who's the manager of Ashoka India Equity. Ayush is based in Singapore, so we're really pleased that he's with us today. And obviously he's managing an Indian subcontinent trust. We've got Amit Mehta, who manages JPMorgan Indian Investment Trust. He's based in London. We've got Gaurav Narain, who is the manager of India Capital Growth Fund, and he's normally based in Mumbai. So again, thanks so much to Gaurav. As I said, it's a totally we've got managers flying in from all around the world for this event, and we very much appreciate it. Again, an Indian subcontinent trust. And then we've got Gabriel Sachs, who's the manager of abrdn Asia Focus. That's in the Asia-Pacific smaller companies sector. So you're not surprised he's sitting on this Indian panel because his biggest holding is in India. He's got 28.7% in India. I'm just going to also add that this trust has a yield of 2.26%, which is different, obviously, to the other trusts here. Right, I've got everybody introduced, so let's get cracking. Now, first question is, why is India's stock market still performing quite so well? We've seen what happened in China, we've seen the stimulus, we've seen the roller coaster ride that's brought. India has just been so strong. And I'm going to start with Ayush.
Absolutely. So if you kind of think about the Indian markets over the last 5, 10, 15, 20, 25, 30 years, a large part of the growth has been driven by the earnings growth in these markets. So over the last 30 years, earnings have compounded at 12.5% in local currency terms. Dollar terms is about 8%. Over the last 5 years, earnings growth has been about 15%, and the markets have grown at 20%. So if you break down the market returns in these two components of earnings growth and multiple expansion, about 75 to 80% has come from earnings growth, and the remaining has come from some bit of multiple expansion. So largely it's got to do with high quality earnings growth driven by multiple sectors. The beauty of the Indian markets is that compared to many other emerging markets like Korea or Taiwan that tend to have just one industry dominating the index, which is semis or electronics, India is a very heterogeneous market. So you've got sort of multiple engines of growth firing, and of these 5, 6 engines, cumulatively, they've delivered 14, 15% kind of earnings growth, and that's the expectation going forward. So it's both a function of the quality of growth as well as the magnitude of growth that is keeping investors globally interested in India.
Right. So Amit, do you want to add to that?
Yeah, look, I could put sort of both an India sort of hat on as well as kind of thinking about it from an emerging market perspective, as you talked a little bit about the comparisons to China. I think absolutely agree with everything Ayush has said. I think what's happened in India that's different, maybe if you take the 30-year view versus the 10-year and the 5-year views, obviously you've had a strong period of political stability, and I know we may come back to that later on, but with that stability has been the ability for India to readdress some of those big deficits that it had. So actually, since the global financial crisis in 2007, 2008, there was about a decade, and you'd call it probably the lost decade for India from an investment side, where actually it grew economically and very much driven by the consumer and consumption side, but services and infrastructure and investment and fixed asset investments particularly didn't really drive economic growth. The change in the last 6, 7, 8, 9 years has actually been a restart of the infrastructure development, the fixed asset investments, and that's reignited economic growth. And to Ayush's point, the one thing that we see, and actually the big difference to what we see in markets like China versus markets like India, is actually economic returns have translated sort of or correlated perfectly with stock market returns. Whereas actually, if you look at China, you've had the opposite, where you've had the economy growing, and we don't need to spend too much time on the drivers of that. You've seen an economy growing, but actually the stock market returns have been negatively correlated, and that's for some structural issues. Whereas I think India's got pretty much a strong underpin on growth on the infrastructure side, which was the one pillar that was missing in the prior decades. And I think that's a bit that's come together in the last 6, 7, 8 years. And actually, as you said, as you look forward from here, which is, as investors, that's what we're thinking about, what's going to happen over the next 5 to 10 years. It's that one pillar, I think, that's going to really re-accelerate the economic growth outlook.
Excellent. And as investment trust investors, we obviously need to see that stock market correlation, in our returns. So that sounds very positive. Now, Gaurav, obviously you're investing in small and mid caps. Why has it been so strong for you, do you think? What's your view?
I think when people look at small and mid caps, the first thing is these are poor quality companies or these are small entities. But you'll be surprised that, we have a portfolio of about 35 odd companies. Most are leaders in these segments. In the small and mid-cap space in India, you possibly find very high quality companies which are industry leaders, great on governance standards, great on technology. And of course, because they're slightly smaller, they're actually growing much faster. So if you really see the earnings growth in the small and mid-cap space is much higher. Not only that, in terms of return ratios, you have as good, if not better, companies generating a lot of free cash. So, you have such a wide basket of companies to pick from. And I'll give you a perspective. Even today, if you look at the market cap of India, there are over 500 companies which have a market cap of over $1 billion. So it's really not a small market. So in the small and mid-cap space, it's a very wide space and very high quality companies, and especially on the governance standards.
Yeah, the governance standards completely. Well, clearly they are doing something very much right, those companies, because they've been performing very well. Now, Gabriel, obviously India is your biggest holding, so perhaps you want to talk about that, and maybe just a little bit versus China. What are your views?
Yeah, sure. One thing I'd add to why India is doing so well is you're really seeing also a domestic investor boom. It's not really been driven by foreign investors. What is quite encouraging to see is that locals are investing in the stock market. There's something called the systematic investment plan. People are putting $30 in every month, and the number of accounts has exploded. So there is a bit of, I think, euphoria as well, with locals being very positive on the outlook for the Indian economy, and that's been channeled particularly to the small and mid-cap space. So you've seen very strong outperformance from small and mid-caps over large caps. I think, the contrast to China is very interesting. I think they almost have a mirror image in terms of the situation of the economy and the outlook. But equally, I think you could say that in terms of the discrepancy in valuations, they are extremely wide. I think, hands down, we favor India at the moment from a fundamental point of view. We have about 30%, as you said, in India, and about 15% combined in China and Hong Kong. But last week, where you saw the stimulus in China and outperformance from the Chinese equity markets, you did see India sell off. So there is, markets don't operate in isolation. So I think there is an element of global investors, emerging market investors, when they want to allocate more to China, they might, take money out of something that's done very well. I think our view is that that's more short term, and I think corrections in the Indian market are probably buying opportunities. But clearly, there is a big discrepancy there, and I think one thing that we need to be aware of is that, when there is a lot of bullishness, there is also the potential for disappointment on the earnings side. So that's something that we try to spend a lot of time on the individual company level to make sure that the prices are reflecting something that's reasonable.
Right. Now, ladies and gentlemen, just so you know how this is going to play out, I'm going to ask about 4 questions, but then I want to go to you. And it's your opportunity to ask questions, because this session really is all about you and your chance to talk to these managers, quite honestly. So, okay, now, we did mention the political situation. Now, we all know there was an election in India, and the result was a shock. Prime Minister Narendra Modi has secured a third term, as we all know, but he failed to achieve an outright parliamentary majority. And the stock market was decidedly exciting a little bit after that election, for sure. I want to know, has that had an impact? Is that something that you're bearing in mind in terms of your management of your Indian investment trust? And I'm going to start with Amit.
Okay. So look, I think for about 24 hours, it was about a shock to the market. And then people kind of looked through it for some reasons. One is there is still an element of political stability. As much as there was an expectation, I think, going into it, that the BJP would come back in with a pretty strong majority. Coming back at all, given the anti-incumbency biases that exist in the market, is a pretty strong outcome anyway. Secondly, I would say at the ministry levels, the BJP have still managed to keep the key ministries. What's more important, what's happening right now, is actually the state elections. And that's something to monitor more closely about whether they continue to have the same level of power that they've had in the past. Now, in terms of the investment implications, look, in every emerging economy, but including every developed economy, politics and political events, of course, play some role. What I would say is actually, in spite of all the changes that we've had in India in terms of governments over the last 30, 40, 50 years, the economy is averaged about 6% real growth. We expect that trend doesn't change. There's some volatility that will come with all of that. And as Gabriel was saying, I think there are areas of valuation that we should be aware of, and I think those political volatilities should be areas to create opportunities for long-term investors. Now, from the way we think, again, about investing, it's very much a bottom-up. So is anything on the politics really going to change the company-level fundamentals, the opportunity for companies to deploy capital, grow, change the sort of actual emphasis on the ground? We don't think so. We don't think there's a significant change that's going to happen. We'll, of course, continue to monitor those, but we think there has been a paradigm shift. And the only thing we're really most conscious of, and some of it was already touched on by a couple of the speakers, which was small and mid-cap valuations. And of course, given that that has been very much dominated by new investors, the retail, the domestics, there is obviously a little bit more risk around that. And I think that risk just creates opportunities rather than being anything structural.
Okay, well, in that case, I have to go to Gaurav. We've come to small and mid-cap opportunities. How about, what's your view? You know, has this political situation had any impact?
You see, if you ask me what is the biggest risk on India today,
Yeah.
it's political risk, simply because it's a very vibrant, noisy democracy. Now, having said that, as Amit mentioned, you know, I would say the next 3 years, the policy measures already done and the sort of projects which are ongoing, you have absolutely no challenge. I think the issue really comes in what next, because, you know, everyone's building in this very strong earnings growth for India, and it's not just a 2-3 year story. You know, people are saying this is a decadal growth of 6 to 7% growth, for which you need to constantly make changes on the policy front. And once you don't have a strong single-party majority, I think 2 years down the line, you'll start facing challenges on implementing tough decisions. I think one big reform measure which really India still needs is on the agricultural side. I don't think that will ever get passed through in this current scenario where you don't have a single-party majority. So and what we're already seeing is, at least at the state level, suddenly because the BJP has lost majority in a lot of states, and the opposition really doled out a lot of freebies, or rather promised a lot of freebies, and you actually started seeing that happen. That a lot of states which are going in for elections, at the state level, everyone's promising whatever. So that's clearly a negative trend. But I would guess the implications will really start playing out possibly 2 years down the line. Currently, whatever the government's done, you had a budget 2 months back, which surprised everyone because it was absolutely growth-focused, capex-focused, welfare schemes came down. So far, I think everyone's very positive about the whole scenario. But longer term, we need that policy continuity, which is what one has to monitor.
I think that was very, very frank of you to say that, quite honestly, that your concern is the political risk, but, everything's sort of settled down. But, looking at what happens next is the real key thing. Ayush, do you want to add anything to that, or do you think it's all been said?
So if you look at the style of governance over the last 10 years, there are sort of 4 defining features of how they have approached governance. Yeah? Number one is around fiscal prudence. So they've kept a very tight leash on government spending, and they've made sure that when you think about government spending in productive capital expenditure versus consumption subsidies, they've kept consumption subsidies at bay. That's the first feature. Second, they have given the central bank complete autonomy in terms of making sure inflation remains in control. Number three, we have seen multiple reforms come through. Bankruptcy reforms, real estate reforms, taxation reforms. So many of the more difficult reforms from a political perspective have been pushed through over the last 10 years. And number four, you've seen a very strong focus on capital expenditure, building out high-quality public infrastructure, and deepening of manufacturing. So that's how I would summarize the four defining features. Now, does having a relatively a coalition government change any of that? To my mind, it is absolutely the most difficult reforms, particularly agriculture reforms and things like that. Those would be the hardest ones to push through. And there might be a risk of slight drift towards populism as more and more state elections come through. But apart from that, the first three is something that we'll see more of the same over the next 5 years.
Right. So rather similar to your views, really. Gabriel, have you got anything to add, or do you want to move it on a bit?
Well, I would just say that I thought the outcome of the election is quite positive, taking a very long-term view, in the sense that I think there was a bit of hubris settling in with Modi and the BJP. And I think it was great to hear your perspective on it, because I think for sure, I think the economic reforms are very important, and I think so far it seems like it's continuity on that front. But I think also having a decent opposition is not an unhealthy thing for the world's largest democracy, and having a secular state is important. And I think there was a risk that potentially it would become more nationalistic. And I think that would be potentially something quite negative over sort of a 10-year horizon. So I think hopefully it's a positive thing to have a little bit of a strong opposition, and hopefully it doesn't derail the economic reforms, although I agree with both of them that on the agricultural front, it'll be tougher now to get through some of those big reforms, which I think would be quite positive for the economy.
Right. Okay, so everybody's decided it's kind of okay, but we've got to kind of be careful for the future, and the agricultural reforms aren't going through. Financial services, now for you three, it is by far your top sector allocation. And I'd like you to just talk through that. Why, which companies, which financial services sectors, and we have to talk about banks, obviously. Of course, we're going to have to talk about banks. Ayush, why don't you kick us off?
Sure. So first, a bit of history. The country liberalized in 1992, and prior to that, most of the banking system was essentially government-owned banks. So in the 1990s, for the first time, the government started giving out licenses to entrepreneurs to start private banks. And then over the last 25 years, 30 years, what you've seen is that private banks have attracted some of the finest entrepreneurs, and they've built credible franchises in the country. So the likes of HDFC Bank, Kotak Bank, Axis Bank, these are some of the finest banking institutions in Asia, and I dare say in the world. And after 30 years of these private sector banks gaining market share, they're still at about 35% of the balance sheet of the country. So even today, 65% of the balance sheet is controlled by government-owned banks who have rather weak credit underwriting, governance, all of that is sort of relatively weaker. So that's the first thing, that private sector banks, I think, present a very compelling opportunity today, especially because of the last 5 years. What we've seen is that these banks have not gone anywhere. There's been a multiple compression. They used to trade at price to book of 3.5 times. And over the last 5 years, that multiple has come down to more like 1.5 to 2 times, 1 year forward. So compared to their core competitive advantages and the opportunity that exists in banking, I think they look super attractive. So that's the first piece, which is private sector banks. The second piece within financials is essentially life insurance and health insurance companies. There's a massive penetration opportunity. Very few people in the country are properly covered when it comes to life insurance. Health insurance is probably less than 5% penetrated. So you can imagine the kind of opportunity, the growth runway that exists for insurance companies. And the third bucket is essentially market intermediaries and market infrastructure institutions. So these are essentially wealth management companies, depositories, stock exchanges. And this part of the financials piece has been on a tear because earnings have grown at 30-40%. Of course, this is the most richly valued subsegment of financial services, but for the right reasons probably. So that's how I would think about the financials opportunity, and we've got sort of healthy allocations in all these three buckets.
Right. Thank you very much. That's a very clear explanation. Now, Gaurav, on the small and mid-cap side, clearly you've got quite a lot of exposure to some of these as well. Can you talk us through that?
You see, I kind of fully agree with what Ayush has mentioned, that, it's great businesses. Banks are very well managed, the private sector. So we're also playing only the private sector. And that's still just 35% of the banking balance sheet, which effectively means even if for these banks, it's all about their own growth because the public sector is inherently inefficient. So you can grow at the pace you want to. So the market is absolutely open for you at the pace you want to grow. So that's the first point. The second is we are very rigid on our corporate governance standards. So there are certain sectors where we've inherently been very negative on simply because there's a fair amount of cash dealing. So you'll see that in our portfolios, we don't invest in any pure infrastructure developer. And the large reason is that historically, these businesses, you need to do a lot of cash transactions because you're dealing with local governments, state governments, etc. So they've never tick-marked our corporate governance criteria. So we find either we play through banks, which are really a play of the whole economy, or we play as the suppliers to some of these developers where you have a better control on what's happening. So by default, we find that this is a sector which is possibly the best representative of the economy, with endless growth simply because you're still a very small percentage of share in great markets. And today, it's possibly the only sector in India where you find a lot of valuation comfort. So, for us,
So they're undervalued, you still think?
They're much below historical averages. So I think banks today are possibly the best valued play in the country.
No wonder you've got so many of them. Amit.
So look, I think Ayush covered it very well. First of all, financials, when you look at the sort of overall allocation, shouldn't just be about banks. And for us, it's very, very similar. We do, of course, we have the private sector banks, and both speakers have talked very well about the opportunity. And the way we think about that is simply that, can you find businesses or industries that will grow and be able to grow for a significantly long period of time above economic growth rates? And when you're starting in an economy like India, you're starting with already a high rate of economic growth anyway. So if you think about it in nominal terms, and banks actually make returns or earnings in nominal terms anyway, but you've got an economy that's growing in nominal terms 10%-ish. You've got the private sector banks particularly, but the banking industry that should be able to grow ahead of that, given the structural deficits that exist. And the private sector banks, given some of the comments Ayush already made, are structural share gainers in this because the state still continues to be the donor there. So in a sense, there's a bit of, if operated and executed well, a bit of shooting fish in the barrel for the private sector banks. And I think that opportunity was the same 10, 20 years ago. I think that's the opportunity still for the next 10 or 20 years. But the industry and the markets on the financial side is becoming a bit broader. So yes, we still have those high quality banks or private sector banks. We do think they're significantly cheaper than they used to be. But there is other opportunities, where that, as Ayush said, some of it's in insurance, so we have insurance exposure. Some of it comes in asset managers, it comes in stock exchanges, and some of the numbers, again, are just, I mean, if you think about it, pretty astronomical. You've got $650 billion in household savings at the moment. That's expected to grow per annum. That's expected to grow to 1.3 trillion over the next 10 years. And at the moment, when you think about what's happening, and we talked a little bit about this in terms of domestic liquidity, you've only got a small percentage of that in the equities, which is considerable given what's happened in the markets. You've only got 4 or 5% of household savings sitting in equities at the moment. And if you compare that with, and it's a very big extreme rate, compared to the US, it's about 40%. So the runway for growth for asset managers, stock exchanges, et cetera, is, again, much more significant than just for the private sector. So we want to have, whilst, yes, when you look at the skylines and the big pillars that show you our exposures, it says, yes, we've got a lot of financials, but not all financials are the same. No. And some of them actually come with very little capital intensity, and that's obviously a better exposure.
I think that's really interesting, those figures, that, quite honestly, so much money and, so little of it invested in the stock market. Definitely. Now, Gabriel, do you have What's your financial sector exposure like in India?
Yeah, we have about a quarter of our 28% in India as in financials. We don't have any banks, primarily because the large cap banks are the banks to own, really. I think I agree with everything that was said. But, I think in the small cap side, we prefer non-bank financials. So that includes sort of specialist financing companies in the affordable housing space or in diversified sort of loans. And then, as everyone mentioned, also in the exchanges side. And yeah, I think sort of the diversified financial space. So we've got 4 holdings in that space.
Brilliant. It's time we throw it open to questions. I can see lots of hands going up. This is great. We need microphones galore. We'll all go here. Gentleman right here, we're going to kick up with the Sprite can. We're going to kick off with him.
Well, 2 questions, one for Ayush and one for my mate Gabriel Zach. First, obviously, I've invested in your fund. It's done quite well, I must admit. It's done me quite well. How do you intend to keep...
Only quite well?
Yeah, well, it's done well. How do you intend to keep growing it? Is there any fundamental might stop it from growing? I mean, what's your plan for the future, considering the election just been finalised and stuff like that? I mean, what's your plan?
Great. First, thank you for the kind words. So when we launched Ashoka in 2018, we started with 45 million. Over the last 6 years, we have grown 10 times. So it's now close to $500 million. And we're fully committed to growing the trust. We're issuing shares, actively. So the hope is that over the next 3, 5, 7 years, it's likely, hopefully, be much bigger than where we are today. We have a team of 35 professionals based on the ground in India, hunting for attractive opportunities day in and day out. And it's a very inefficient market. There are plenty of opportunities to extract alpha from.
To expand and extract, yeah.
Great.
Thank you very much.
Thank you.
Yeah.
And your question to Gabriel?
Gabriel basis. Obviously, you've invested in India and China, but Vietnam is the next big growth area of my research. Any intention to expand to that area yourself?
Yeah, no, great question. We do have Vietnamese exposure, so it's not part of our benchmark per se. So on a relative basis, we're quite overexposed to Vietnam. We almost have as much in Vietnam as we do in China. So we have about just under 7% in Vietnam. There's one long-standing holding we've had for about 6 years called FPT, and that's done phenomenally well. We're starting to take some profits off of that and direct it elsewhere, but now we have 4 holdings in. We actually bought our 4th today. So, yeah, we've got 1 in consumer, 1 in tech, 1 property developer, and a bank. But to be frank, it is a very narrow market, so it's taken us a while to broaden that exposure because. Yeah, I think from a macro point of view, I'd probably say India and Vietnam are the ones I'm most excited over sort of a 10, 20-year horizon. I think there's a lot of growth there. But I think the difference is India just has that breadth and depth that Vietnam doesn't have. So hopefully, over time, Vietnam can offload more companies into the market, particularly state-owned enterprises. There's a lot of state ownership still. And also the governance standards need to improve and access, etc.
At this stage, I have to say we do have 3 Vietnamese investment trusts, and one of them's out there. So there's no shortage of choice. Thank you for your questions. Next questions, please. Gentleman right here. Gentleman, you might know something about investment trusts, actually.
China had a very well-documented and massive property bust, both residential. Is there any part of the Indian economy where there's excess leverage that keeps you up at night?
Good question, Michael. I like it. What's keeping you up at night? Is it excess leverage? What is it? Gaurav, let's start with you.
Actually, you'd be surprised that leverage in the Indian economy is at its lowest ever in history. A lot of it is to do with the fact that, when you had the reforms in 2015 to 19, both in the bank, at the tax reforms and in the banking sector reforms, a lot of cleanup happened then where, especially in, say, real estate, you hear that almost 60 to 70% of developers collapsed in that period. A lot of consolidation happened in steel and cement. And that was a phase when every company looked inwards in trying to address the balance sheet. So today what you have is a scenario is that despite the sort of growth you've seen, the balance sheets of companies are the cleanest ever. Debt is very low. In fact, there's been a lot of liquidity in the market, so you've seen a lot of fund offerings. You'll see a lot of IPOs have happened or companies, listed companies raising capital, but none of the large companies have raised capital because their loan leverage is very low. And all the funds being raised is largely capex for capex. Even the real estate sector, it's absolutely cleaned up today. So the whole model has shifted. So really, I would say health of the economy has never looked stronger, which is where the confidence is arising that, on all parameters, India is in a very, very strong position. And the ROE of the Indian economy itself is about 16%. I think there's only one other country which is slightly higher, and that's in the US with about 18%. So really, I would say it's never looked better in terms of the health of the corporate sector. And this is across sectors.
Well, that's extremely encouraging. Amit, have you got anything to add on that?
No, look, I'd agree with all the comments made. There was a cleanup. It's not like India hasn't had a cycle. So, pre the financial crisis, there was a lot more property developers. There were a lot more infrastructure companies. There were a lot more cement companies. They were a lot more levered. And that didn't, it didn't end well for any of them. And it's just become, as Gaurav said, it's become more consolidated. It's become cleaner. India's not had that same economic cycle yet. But it looks like the way we're going through the next economic reforms and growth is actually much more managed rather than the boom bust we saw 2005 to 2008. So as long as it carries on this same trajectory, I think the leverage levels, as mentioned, are already very, very low. Two, they can be managed internally.
Thank you for your question. Right, next question. Oh, over here. Thank you very much.
Thank you. To each of the panellists. Under what circumstances might you envisage reducing your weightings to small caps over the next year or so?
Okay, and first of all, we need to know how much you have. Obviously, Gaurav invested in the small and mid caps, so maybe we should kick with him.
So I think we are possibly 40% of our fund is small caps, another 50 odd maybe mid caps. But I think we are finding a lot more opportunities in the small cap space. And I think the markets, the breadth and width and depth of the market is really expanding, especially with the sort of new IPOs which have also come. So my sense is our exposure to small cap will only increase going forward.
Gabriel, have you got small cap exposure?
We're only small cap,
yeah,
really.
You are.
I think
you're in the Asian small cap sector.
Yeah, we did remove the market cap limit of the trust. It was quite restrictive before. This was in 2022. It was 1.5 billion, so it's very small. So we're almost a micro cap fund. So the removal of that cap has actually been quite nice, because actually in big markets like India or like China, we can access bigger companies. And that's been absolutely necessary. And I think, as Gaurav said, I think there's been a lot of new supply of companies to the market. I think I was reading, actually coming here today, that I think the market share of India in new IPOs this year is 17-18% globally. So most of the IPOs in the world are coming from India. And you're also seeing a lot of secondary sales from private equity investors. So there's quite a lot of opportunity. I'd say that the hard thing is getting a good allocation.
Yeah.
Occasionally we put in for IPOs and we get, 5-10%. And we're seen as a large institutional manager that people want to have us in. So I think one of the things that we're trying to explore and that hopefully we can do more of is pre-IPOs, which we haven't done any of before. But I think with the trust structure, hopefully that's something that we can do a little bit of. I think we'd be very cautious, but I think, in that sort of 6 months to IPO stage, I think it's quite helpful.
Trust structure would be ideal for those kind of investments, absolutely. Ayush.
Yes, we have 60% in within small caps. So let me just talk about what small caps mean first, right? So India is a $4.5 trillion stock market. Just for context, US is 50 trillion, number one. Number two is China, about 14, 15 trillion. Number three is Japan, 6.5 trillion. And then you've got India, which is 4.5 trillion. US has 4,000 listed stocks for 50 trillion. India also has several thousand listed stocks. Our investment universe essentially is anything that is more than $250 million market cap. That leaves us with 1,000 companies in India. Out of these 1,000 companies, the top 100 is large caps. The next 150 is mid caps. And stock number 251 to stock number 1,000, which is 750 companies, that's small caps. So when you say small caps, there's a wide dispersion of relative value across sectors and industries that you can pick from. So there are certain pockets which are overheated. There are certain pockets where you can find a lot of value. So I've not worried too much about headline valuations of these 750 companies in aggregate. There is a lot of bottom-up opportunities if you're willing to turn a lot of stones.
Amit, do you want to add?
Yeah, so look, firstly, we run sort of an all-cap strategy. We don't start by making a decision or allocation on the size of the company. So we're going to go wherever the opportunities or the business quality takes us. And then our judgments are in that order. Where can we find a great business? And then where do we think we're going to make an attractive return on those businesses? So we don't start with a view that actually small caps or mid caps or large caps and where the relative valuation is, because the underlying drivers are going to look very, very different. So you could have a very similar business in a similar industry, but a smaller business has the ability to deploy capital and grow at a much faster rate purely because of its size and maybe the opportunity. So you should be, or you may be willing to pay a little bit more for that. Now, there are obviously points of where valuation convergence or divergence become a big and differentiating factor. And I think there are certain areas in the Indian market that those pockets of, call it valuation froth, do exist. And some of that is very much driven by the nature of the investors that have been in there. So local, domestic or retail-orientated investors obviously are looking at things that have done very well, or maybe news flow driven or momentum driven. And so obviously that does attract some maybe shorter term type of capital. So we're just more, I guess, more aware of that. But from an allocation perspective, I never really start with, I want to have more or less in smaller mid caps. The trust structure, as everyone's described, does allow us to take more liquidity risk, but we'll do that sort of prudently.
I think we've probably got time for one more question. I'm assuming this session finishes at 3:40, if somebody can wave at me. Right here, let's take this question.
Yep. Hi, thank you so much.
Quickly.
So before asking my question, I'll just say that I already have a research business in India in small caps.
Sure. Good.
So India's market cap to GDP ratio has a median ratio of 80%. We are right now standing at 140. Is there a concern we are lingering around? Because if the market is to be available at the same valuation, we will take 11% growth over the period of 4 or 5 years. So haven't we already raised too much ahead?
Shall I take a stab at that?
Everybody's looking at each other.
I'm happy to take a bit of
going to dive in.
Well, I'll take a stab, but I'll let the others kind of chime in. But obviously, there's numerators and denominators, right, there that we have to consider. And the numerator on the market cap number that you referred to is a reflection of the listed Indian equity universe, right? And when you look at that versus other large markets, actually, there's just a lot more listed equity. So I think the opportunity, you talked a little bit about how big the tail of the Indian market is, but actually we're only really starting in the last couple of years to see significant new issuances come to the market. And I think if the market remains buoyant, you can naturally just see that headline number drop just by the number of new issuances that come to the market. So on its own, I never really take in the same way that I don't take headline country level PEs and go, the country's expensive on its own or the country's cheap on its own. I think you have to kind of go below the hood. And I think actually, as a listed sector in India, you're still quite early on. So I think the opportunity to kind of broaden, deepen has happened. And that's why the opportunity set's changed dramatically in the last decade. If I was like to take a crystal ball and say what's going to happen in the next decade, I would say it's going to continue to broaden and deepen. And so your numerator will change, and it will change probably quicker than your denominator.
Okay. Would anyone else like to talk about that? Gaurav?
You know, on a broad brush, I would say India is definitely very expensive. How we look at it is, we don't really look at market valuation, but we look at our own stock which we own in the portfolio, and you're fairly concentrated. So every stock we own in our portfolio, we have a fair value at what it should be valued at. And to give you a perspective, today almost 80% of those stocks are trading above fair value. And it's not that they're trading 5% above, they're possibly almost 15 to 30% above fair value. So it's very hard for me to justify the valuations a lot of these stocks are trading at. So having said that, how do you manage your portfolio in such a scenario? What we are really doing is trying to ensure that every stock we own in a portfolio, we have high degree of confidence on the predictability of the earnings growth, really the predictability, so that if valuation's correct, you have earnings which will bail you out. So that's really our focus, that yes, my own sense is, ideally I'd be very happy if the market does nothing for the next 6 months and you have the earnings play catch up. Because the fact is, Why are the markets expensive? It's simply because people are believing that India will grow for the next 5 years, and that growth is really almost 14 to 15% for the market as such, and a lot of stocks growing higher. So that's your bigger call, that, growth will not disappoint. If growth disappoints, then we have a problem.
I'm just going to bring Ayush in very briefly here, Ayush. These valuations, are they keeping you up at night? Are you happy?
No, I think so. So the approach that we take is one of relative value. We don't tend to have strong views on whether this market cap to GDP goes to 150 or 120 or 130. Even if we have a view, it does not really influence how we approach investing. So we keep our macro views and bottom-up stock selection separate. Now, with that lens, when you start viewing the various sectors in the market, in financial services, in technology, in healthcare, in industrials, can you find companies you're not investing in the index? Can you find companies that are, the index could be at 25 times or 20 times, but can you find companies that are relatively attractively valued compared to the broader index? And the answer is yes. And if you take this approach and you apply this sector after sector, industry after industry, you end up with a portfolio that is far more, from a growth and from an economic perspective, is far more attractive than the index, while it is lower rated than the index. And that's how we approach our job as investors. I do agree it looks punchy. Probably the earnings do need to, there's no room for disappointment, but there is more than enough if you have this bottom-up relative value approach to investing.
Thank you very much. I'd like to thank all of our managers. I'd like to thank you for all your questions. Now, if you would like to go and see Justin Webb, please go and make your way into the main room. But first of all, I think we've got to give them a round of applause.